The United States has 54% of all adult Americans invested in the stock exchange, according to Dennis Jacob, chief economist and author of Gallup Economy. Seeing such a high percentage shows importance to learning about the different types of stocks and how they may benefit. With the increase in numbers, it would be beneficial to learn the ins and outs of the stock market, invest yourself, and gain the financial benefits of doing so. With that being said, I have gained interest in investments, and over time I have begun to research the essentials in investing in the stock market and seeing the financial gain that it could bring me someday. When learning the basics about a stock, one should first learn what a stock is. A stock constitutes equity stake to its owners and represents the assets of the company that would be awarded to the shareholders, allowing them claim to the assets and earnings to the company. To reap the benefits, one would need to know the basics about the stock market. For instance, making money with stocks, evaluating stocks, and learning the different types of stocks. There are different ways one can make a profit when investing in the stock market. When planning the investment that would benefit one the best, there are a few options to take into consideration. One option of financial gain in the stock market is through a dividend. A dividend is a cash distribution by a company to its shareholders. What that means is that when a profiting company reaches an increase in profit, it has two options. They can either reinvest the money or pay out their shareholders through a dividend. The benefit of this would not only be to increase the profit of a shareholder, but also the company will increase from a lower tax rate at the end of the year, potentially saving more money in the long run. Many people who invest in dividends are retired individuals who use the monthly or annual money as a supplementary income for retirement. Also, younger people who are looking for a method of income in the long run will invest in dividends. The benefit of investing in dividends is not only for the supplementary income, but also has a low risk involved for an investor. Typically, when searching for the right company to invest money, and one will look for the company that is most profitable and has a stable history, and in doing so, that sets the investor up for financial success in their investment. According to Investopedia, other than the obvious reason for investing, to invest in a company that's well off, one would benefit most companies who tend to pay out investors 2 to 3% annually will continue to do so, and once they build that reputation, they will continue to live up to their expectations, and if anything, they will increase their payout by a fraction of a percent annually. It is not always guaranteed, but a high profitable company typically does not want to disappoint their investors. The other option is to use when making money with stocks is through capital gains. A capital gain is an increase in the value of capital asset that gives it a higher worth than the purchase price. In layman terms, it is the difference in cost of the share from purchase price to selling price. The capital gains income is collected through a tax rate on the particular stock, and the tax rate varies depending on whether it's long-term or short-term. A long-term gain is the share that has been held for over a year, where the short-term gain has been held for less than a year. According to the Tax Policy Center, taxpayers in the 10 to 15% tax bracket pay no extra cost on a long-term gain, and taxpayers in the higher 15% pay 15% on long-term gains. Short-term gains are taxed the same as regular income and require no extra percentage. Although it does sound easy to invest money in a share and sell when the time is right, walking away with a profit is not always easy. With great reward comes great risk. For instance, if someone invested $5,000 in Eastman Kodak Company over 10 years ago, they would be collecting a large capital gain upon selling their shares. But if you waited to sell a $5,000 share, it would now be down 90% with a steady decline and no increase in sight. This is Frank Carson, author of 10 Worst Performing Stocks. That is part of the gamble when investing and making money from capital gains. We have discussed how dividends and capital gains are the way to make money in the stock world, but now learning which type of stock to use can decide the profit of an investment. The two main types of stocks to invest in is common stock and preferred stock. Deciding between these two will depend on the preference of the investor. The two main types of stocks. Common stock is described well by its name. It is the most common form of stock and is broken down by dividends and gains, as described earlier. Typically, when someone is mentioning stock, this is the type of stock they're talking about. Common stock is part ownership of a company via dividends, where a board is elected to uphold the management on decisions made for the shareholders' payout. Having this board to make the decisions can control the percentage of the payout one will receive. Common stocks over a long period of time can be referred to as capital gains, which, like mentioned before, can include high payouts to complete loss of investment due to bankruptcy. Preferred stock differs from common stock in the fact that it does not include a board of directors to dictate the variable income one will receive from the share. The variable rate is fixed, meaning the shareholders will receive the same payout each time. This can obviously be a positive outcome if you want a dependable income, but it'll also limit the chance of receiving a large payout in the event the shares increase substantially. Preferred stock can also be beneficial because all preferred shareholders receive a payout before common shareholders. Now that we've discussed the positives for purchasing preferred stock over common stock, we will discuss why more investors choose common over preferred. The great value for preferred shareholders is brought on because the company has the option to purchase the stock at any time from a shareholder. For this reason, some people prefer stock as a debt in a company rather than equity in a company. Once the decision has been made between common stock and preferred stock, there comes the decision on what company to invest in. Before doing so, you must evaluate these companies. When evaluating stocks and deciding on what would be best for the budget and time, there is a few things to do. First, ask questions to build knowledge about the possible investment. To evaluate the methods of approach to ensure these questions are followed correctly. First question to ask would be, what does the company do? For example, are they selling product in demand? Second question would be, is the company profitable? When checking their financial history, do you see an incline or decline in the profits? Thirdly, what is the company's earnings? What's the company's earnings history and outlook? Again, double check financial history for any key signs of financial struggle or any hardships. How richly is the company's new stock valued? What are the professionals saying? Do they see a positive outlook for this company? Who are the company's competitors? It is always ideal to check the competition to see which direction they're headed and will it affect your stock interest. The sixth question to ask would be, who runs the company? Is the company's owner a trustworthy owner or investor looking to make a quick profit? 7. How clean is the company's balance sheet? This will show the company's assets, liabilities, and your equity in the company. Number 8. Have you read the company's annual reports? Do this so you will ensure your investment will be done at the right time of year. Number 9. Are there any red flags that call question to the company's integrity? Does the company operate in a way that goes with your own values or against your values? And number 10. Is the company's competitive position sustainable? Is the product being sold something that you see that will stay in demand or is in demand? By following that list or similar list of questions before making a stock purchase will increase the odds of making a successful investment and maybe someday yield some financial gains. When planning a method to evaluate the questions listed, there will be several options. One method would be using a program online. There are dozens of programs to choose, but a great example would be Scottrade or Ameritrade. These websites offer strategies that will help manage risk, determine potential growth in companies, and maximize the chances for financial gain. And if technology is not a preferred method of evaluating potential investments, try consulting a professional financial or a stock and bonds broker. This method will provide unlimited easy access to knowledge and support while trading stocks. Most cities are full of financial consultants and brokers, so finding one should be easy. But the one downfall is finding one that you can trust and will not just take advantage of you to make a quick profit. The simple solution to avoid that from happening is to research the consulting firms before making your final decision. The stock exchange has been a thriving form of investments for over centuries, and though there have been several drops in stocks over the years, it is still one of the most valuable forms of investment. A few things to consider is asking the basic questions: how to make money with stocks, what types of stocks are there, and how to evaluate stocks. Once these questions have been taken into consideration, it does ensure a successful investment, but will give knowledge into what to expect, where to place your money. Remember, people have been doing this for a long time, and there's a reason for that. So next time you watch the news and hear them mention a steady increase in our stock market, imagine all the happy investors receiving a large payday for something as simple as buying a share in a company.
Bruce.